The coronavirus outbreak dominated trading, triggering risk aversion, weighing on global equity markets, and accentuating the move down in bond yields, which kicked off at the beginning of January. The epidemic continued to spread in China, forcing the authorities to introduce increasingly drastic measures in an attempt to stop propagation. The World Health Organization declared an international emergency, but said there was no need to restrict travel and trade. So far, there has been no panic. The mortality rate is still hovering around 2.5%, and Beijing has been quick to take draconian action. Financial markets are nonetheless worried about the impact on global growth from production stoppages, reduced traveling, and Chinese consumer spending. The general resurgence in risk aversion, nevertheless, cloaks sharply diverging performance across segments. Asian markets have suffered the most, along with export and industry-heavy markets in Europe. Luxury, technology, airlines, and raw materials, including oil, have been the hardest hit. All have seen heavy profit-taking after strong performance in 2019. Meanwhile, the impact on interest rates has focused on government bonds. As a result, we could be in for a longer than expected period of ultra-low interest rates. This, at any rate, was the sentiment after the Fed and Bank of England policy meetings stuck with their accommodating bias. The Bank of England also underlined the fall in the UK's expected growth rates just ahead of the country's effective exit from the European Union. All of these issues overshadowed better than expected economic data on consumption in Europe and the US amid record employment levels. The US also saw particularly upbeat data on GDP, new orders, and regional purchasing manager confidence levels. Europe, Germany, and France, nevertheless, reported disappointingly flat industrial confidence levels and GDP. France only grew by 0.8%. Strong liquidity flows, resolutely accommodating monetary policies, and the lull in trade war mean emerging country equities and bonds are still attractive. When China's markets reopen for business, we intend to partially reduce U.S. equity exposure in favor of emerging country equities. European markets were dragged down by worries over the coronavirus spread. In company news, Spanish banks reported good quarterly figures. BBVA rose 3% after its net earnings came in 10% above expectations. Capital generation also beat estimates. After a disappointing third quarter for capital generation, Santander, up 2%, had a sharply improved fourth quarter, with CET1 coming in above expectations. The bank also reiterated its guidance. For the first time in years, LVMH's fourth quarter missed expectations. Fashion and leather goods, which have strong operating leverage, performed well, but failed to offset relative softness in watches, spirits, and distribution. The stock lost 4% over the week. Elsewhere, Airbus said it was close to an agreement with anti-corruption authorities in France, the UK, and the US on terminating ongoing investigations. This will help improve visibility on how the group uses its balance sheet. In quarterly reports, news from French companies Elis and JCDecaux both managed to reassure investors on operating performance despite the impact of France's strikes for Elis and Hong Kong's demonstrations for Decaux. Worries over China's coronavirus sent U.S. indices lower, but this left the S&P 500 and NASDAQ still up by a significant 1.6% and 3.6% since the beginning of January. Fourth quarter GDP grew by a solid 2.1%, and the first quarterly earnings figures came in better than expected. Technology ended the week in positive territory on upbeat figures from Microsoft and also Intel, beating consensus expectations by 20%. Netflix and Tesla continued to trend higher, while Facebook retreated after its results revealed a sharp increase in spending. Oil was the week's biggest loser, with the S&P 500 Energy Index down by an unwarranted 3.7%. Hess suffered a similar fate. shedding 7% despite upbeat quarterly figures and a robust production outlook. Healthcare stocks fell, leaving the S&P 500 healthcare index down 3%. Health insurance plan providers like Anthem and United Healthcare lost ground due to higher medical costs over the quarter. Pfizer dropped due to poor visibility ahead of its plan to spin off Upjohn, while biopharma product sales rose by a solid 8% over the quarter. Japanese stocks lost ground on mounting fears the coronavirus might spread. Tokyo was hit by global investors going risk off during the Chinese New Year week when other Asian markets were partly closed. The Nikkei declined 3.56% and Topix fell 3.22% over the period. Concerns over the impacts on the global economy hit economy-sensitive sectors like iron and steel, electric appliances and machinery, and air transportation. China-related stocks, as well as tourism names, were also weak. Oriental Land tumbled 10.14% on worries over reduced foreign visitors to Tokyo Disneyland. The MSCI Emerging Market Index tumbled 4.2% over the week as the coronavirus spread in China spurred concerns on global growth and Chinese consumption. In an effort to strengthen containment of the epidemic, Chinese authorities announced the extension of the New Year holiday break and additional travel restrictions. The pneumonia-causing coronavirus was also declared a global health emergency by the World Health Organization on Thursday. China's official manufacturing PMI came in at 50 for January, or slightly below expectations. On the company front, Huawei received the UK's approval to supply 5G equipment such as antennas and base stations. That's all for today. Thank you for watching. Subscribe to our channel to track the market pulse and get the latest economic data. Good luck trading.